Unit 4. The Theory of Double Entry. Session 2. The Double Entry Principle for Recording Revenues and Expenses. By the end of the session, you should be able to state the double entry rule for revenue and expenses and identify the account to be debited and the account to be credited in transactions involving revenues and expenses. The double entry rule for revenue. Increases in revenue account are entered on the credit side and decreases on the debit side. For example, assume a transaction in which goods are sold for cash. Two accounts are affected, both an asset account, that is cash, and revenue account, that is sales. So cash increases and sales increases. Cash is debited and sales is credited. So sales is a revenue account and sales is credited to show the increase. Double entry rule for expenses. Expenses account are increased on the left or debit side and decreased on the right or credit side. So it is expected that the expense account will have a debit balance. Let us look at a situation where business pays cash for wages and salaries to employees of the business. Here, two accounts are affected. An asset account, cash, is reduced. An expense account, wages and salaries, is increased. Hence, wages and salaries account is debited and cash account is credited. You should note that the expense reduce cash or bank or create a liability, a creditor. In a nutshell, expenses and losses, we debit to show increase whilst we credit to show decrease. It is also expected that expenses will have a debit balance. Whilst for income, revenues and gains, we credit to show increase and debit to show decreases. In this session, we stated the double entry rule for revenue and expenses and identified the account to be debited and the account to be credited in transactions involving revenues and expenses. Thank you.